how your credit score is actually calculated. Your credit score is a very important 3 digits. The three main credit bureaus are TransUnion, Experian, and Equifax. While we are going to educate you on how your credit score is determined, what you really need to know first is that there are over 50 different scoring models. Have you ever known anyone who monitors their credit with free sites such as like Credit Karma, Credit Sesame, CreditWise, and others? And they see one score, but when applying for a loan, they're told their score is completely different? There is a reason for this. That doesn't make those scores wrong. Those scores are just a different scoring model. You can go to a car dealership same day, and they will tell you your score is X. You can apply for a personal loan same day, and they may tell your score is Y. And if you apply for the home loan that same day, they may even tell you that your score is Z. Free sites, as mentioned before, give you what is called a Vantage 3.0 score. But banks, loan companies, finance companies will determine your credit worthiness looking at a FICO scoring model. There are several different types of FICO scoring models: FICO 4, FICO 8, FICO 9, and even more. These FICO scoring models are always changing. But here's the truth. While every bank has a minimum score requirement, it's not your credit score that gets you approved or declined. It's your credit report. Your credit report is the most important factor in making the loan decision. Your score will dictate the interest rate. Think of it this way. If your credit score is 700, but you've had a repossession in the past, you will score lower on the internal banking system. If your credit score is a 650, but you have a student loan in default, no mortgage loan company out there can get you approved until that loan is in good standing. And this is why your credit report is more important than the actual score. Make sense? So, you have to have open and positive accounts to actually improve your credit score. Your credit score is all about how you are handling and how responsible you are with your credit in those accounts. If you have bad credit and you take care of and remove all the collections, but you have no open accounts, your credit score is actually going to go down. But you do not have to create debt to have credit, and we'll talk more about that later. Now that we understand the differences in scores, let's actually talk about how your credit score is actually calculated. There are 5 determining factors that make up your credit score: payment history, credit utilization, length of credit, new credit, and types of credit used. And we're going to go over each one of those in detail. Payment history accounts for 35% of your credit score. This is the largest determining factor of how your credit score is actually calculated. Making your payments on time is crucial. One 30-day late payment can dramatically drop your score. But let's talk about that for a minute. You are only considered late to the credit bureaus if you are 30, 60, 90, 120, or 150 days late. So what that means is if your payment is due on the 1st, but you don't get paid till the 7th, you are technically not late to the credit bureaus. Now, same token, if you are 10, 15, 20 days past the due date, many financial institutions will add a late fee. But you are not reported as being late to the credit bureau until you hit that 30-day mark. So whatever you do, do everything you can to keep from going 30 days late. You need to keep a close watch on your credit reports. We have seen many credit furnishers report being late to the credit bureaus when you're not truly 30 days late. This is very easy to prove, and you should be able to get that late payment reversed. In a later video, we will explain and provide a letter template to reverse those late payments. If your account does go 60, 90, 120, 150 days late, that credit furnisher will more than likely close that account. That does not mean stop making your payments. Just because they close an account, if there is a balance, they will continue to report your payment history until they charge off that account, which is the point of no return. A charge-off is worse than a closed account with late payments, and we will discuss how to handle charge-offs in a later video. If you are struggling financially, if you know you're going to be late, it is incredibly important that you communicate with your credit furnisher. Do not avoid phone calls or communications from that lien holder that are currently open accounts. You would be surprised how many banks are willing to work with you during tough times. But if you avoid them altogether, it will compound the situation and make it worse. The next part, the second biggest portion of your credit is credit utilization. Credit utilization is the second biggest factor in determining your credit score, which is 30%. Credit utilization has everything to do with revolving credit, which mainly includes credit cards. This is some of the most overlooked, feared, and misinformed portion of your credit score, what we like to call myth understandings. We are going to clear all of that up for you right now. Revolving credit is generally associated with credit cards, but many furniture or appliance financing options will report as a revolving credit account. Credit utilization has everything to do with what is your balance versus your limit. The more you have available, the more credit points you will receive. So in essence, if you do not have a credit card or an open revolving account, you are automatically missing out on 30% of your credit score. That's like taking a 100-question test, only answering 70 questions and hoping to get a good grade. On the same token, if you have a credit card and you max it out, you are losing that 30% just like you don't have a credit card. Remember, the more you have available, the more credit you get. This is why you do not have to be scared of having a credit card. If you are taught how to correctly use your credit cards and you are disciplined not to lavishly use your credit cards, there is nothing to be afraid of. If you keep your balance under 10% of the limit, that will keep you in the excellent range. Any balance under 30% will keep you in the good category. But if your balance starts to exceed that 30%, you will see a decline in your credit score. The downside to buying furniture or appliances that report as a revolving account is that credit furniture generally will loan you the amount of the products you're purchasing. So in essence, if you finance $2,000 in appliances, they will open an account for $2,000 and they will report a $2,000 balance, which technically maxes you out. One way to avoid this, if possible, get pre-approved with a higher credit limit before purchasing. If you get approved for a $4,000 credit limit, but only spend $2,000, you will be at 50% utilization and not 100%. Now, remember when we said you do not have to create debt to have credit? Many of you have heard to build credit, you need to get a credit card or a secure credit card and maybe charge a few tanks of gas or buy some groceries and pay it off every month. This is technically incorrect and a bad plan that may be setting you up for failure, and here is why. Number one, you are creating debt. Debt you may not have budgeted for, or you may have had an unexpected expense, and when you get your bill at the end of the month, it's very easy to just want to pay the minimum payment. This just negatively affected your credit score. Number two, there is a huge difference in the due date and the reporting date. The due date is when your payment is due, but the reporting date can be several days before the due date. So even if you pay off the entire amount owed on the card on the due date, your credit card company has already reported your balance. And if you have a credit card with a limit of $200 or $300, a couple tanks of gas and groceries will easily exceed that 30% credit utilization limit, thus making your credit score go down. You can call your credit card company and ask, when is the reporting date? And you should mentally make a note of that date, that now becomes your new due date. And you be sure to pay down or pay off the balances before the reporting date. We suggest that you pay a bill that you have already budgeted for with your credit. And here's what we mean. So every month you should be budgeting to pay your electric, your water, your cable, your internet, or your cell phone bill. And if you pay that one bill with your credit card, you turn around and pay the credit card off within 24, 48 hours. It's already budgeted money. Now you showed activity. You paid it off before the reporting date. You didn't pay any interest, and the payment history is building your credit along with the low utilization rate. We have always heard to keep a few dollar balance on a card instead of paying it completely off, but we have actually yet to have confirmation that doing that actually builds credit faster. Either way, You will accomplish all of this without creating debt. All right, so story time. So we had a client that came to us for help with some negative items on his credit report, and he wanted us to help build his credit. This client was trying to already build his credit on his own, but he was making a big mistake. This client had one credit card with a $4,000 credit limit. And every month he would charge everything he had and basically max that card out. But he would pay that card off in full every month at the time of the payment was due. Then he would charge it up again and pay it off the following month. He thought he was showing responsibility of charging a lot and paying it off in full, which was trying to help his credit. But what was really happening is that every month it was reporting his balance before he actually paid it off. In the following month, he was already maxed out again at the time of reporting. So in essence, it never looked like he was ever paying it off each month. As soon as he was educated about this, he started paying off his balance before the reporting date, and he saw almost a 100-point increase in his credit score immediately. Do not create debt to have credit. The more you have available at the time of reporting, the more credit you will get. Now, what do you do if your credit is young, or if your credit is bad, you've had some mistakes, and you don't qualify for a traditional credit card? This is where a secure credit card comes into play. A secure credit card requires a deposit, and your deposit amount is generally going to be your credit limit. Most banks and credit unions will offer a secure credit card option. These cards will generally cost between $300 and $500. But we have a much better offer and program for you. We have a partnership with MasterCard. Many banks and finance companies contact us to get their clients started with our MasterCard program, and here is why. 1. Our MasterCard is only $200, so it's less expensive. But there's a way bigger benefit than just being less expensive. So let's go back to your bank's secure credit cards. So you take them $300 or $500. They then have to mail you that card, which you then have to activate. And a month later, you're going to get a bill, and your payment's due 30 days later. That payment may not be reported for another 30 to 45 days. So in essence, you can apply for the card today, but it may take months for it to actually report your payment history and your balance. With our Credit Builder card with MasterCard, after you make your $200 deposit, it will take about 3 weeks for it to arrive. Even before it arrives, it'll report to all 3 credit bureaus and it'll show that you've already made a payment, thus building your credit faster. To apply for our Credit Builder card, go to the links page and click the link. It's all completed online and it only takes less than a few minutes to complete. So to recap, credit utilization. You have to have a credit card or a revolving card account to maximize your credit score. You have to have a revolving account to get credit for utilization. The more you have available, the more credit you will receive. You do not have to create debt to have credit, and now you shouldn't be afraid to have a credit card or credit cards. So now let's talk about length of credit. This is the third determining factor in actually calculating your credit score, and this is 15% of your total score. Basically, how long has any account been reporting an open? The longer you have an open account, the greater your score. So try not to close any accounts. Now this is where they get you. If you finance a vehicle, the typical loan term on a vehicle now is 60 to 72 months. And you're obligated and you're supposed to make your payments each and every month until that loan is paid in full. When you fulfill your payment obligation, they will close that account and you will see a decrease in your credit score because you just paid off and technically closed an account. I know, it sucks, right? Unfortunately, this is just the rules of the credit world. Credit cards will typically not close as long as there is activity in every few months, and you do not fall behind on your payments. This is also where mortgage loans and student loans can help with length of credit because typically those loans have longer terms. Do what you can to keep accounts open and in good standing for as long as possible. Now, new credit is 10% of your credit score. What is new credit? New credit is your inquiries. Inquiries are not as detrimental as people think. There are reasons why people think inquiries hurt more, and we blame that on what we call myth understandings. Free credit monitoring sites like Credit Karma and Credit Sesame, basically any credit monitoring site that provides a Vantage score. You ever known anyone that has went to a car dealership and that dealership was shopping for an approval by submitting your credit to several different banks? That person then gets upset after they check their credit monitoring and sees a drastic drop. Keep in mind, credit furnishers, banks, and loan companies, they're determining your credit worthiness for a loan off of the FICO score model. Your FICO score is not affected by inquiries like your Vantage score are. You are allowed to rate shop when applying for an auto loan or a mortgage loan. This means you can have your credit pulled or ran as many times as needed within a 14-day period. As long as each credit inquiry is for the same purpose, at the end of that 14-day period, your FICO scoring model will look at all of those inquiries as just one inquiry. You really want to limit the credit inquiries to less than 6 per year. There is a difference between soft credit inquiries and hard credit inquiries. A soft credit inquiry generally does not have any effect on your credit score. Many times your social security number is not even required for a soft credit inquiry. Credit card companies can do a soft credit pull to determine if you're pre-qualified for a credit card or maybe for a limit increase. Employers may also do a soft credit pull when considering you for employment or a promotion. You can stop all companies from performing soft credit pulls without your permission. We have provided the opt-out in the second round dispute template in your document section. Hard credit inquiries are any time your information is submitted to make a lending decision. A hard credit inquiry can result in a loss of a few points. If you did not give a company permission to pull your credit, those inquiries can be removed. And never dispute an inquiry of an open or closed positive account. This could result in removal of the entire account along with the inquiry. So the last determining factor in your credit score is types of credit utilized. There are 2 types of credit: revolving credit and installment credit. As we have just talked about earlier, you should already have a good understanding of revolving credit. But I'm going to explain the difference between the two in more detail now. As mentioned before, revolving credit has no definitive term. The balances, the limits, the monthly payments can change. Revolving accounts will typically be your credit cards and some furniture or appliance loans. Installment accounts are loans that have a set amount, a set payment each month, and a set term that the account will be paid in full and closed. Installment accounts would be car loans, home loans, student loans, personal loans, recreational vehicles, etc. It is very important to have a mix of credit. If all you have open and positive are credit cards, you will need to add an open installment account. Now remember, we do not create debt to have credit. So I'm not saying you have to go buy a car or take out a personal loan if you don't already have a mortgage. Matter of fact, there are some myth understandings out there that tell you to do just that. Some banks offer credit builder loans, and those loans can be very helpful sometimes. But I have seen some banks that give an offer of a credit builder loan that can charge interest and double-digit interest and have a monthly payment of $100 or more. These are not smart choices. 1. The interest rate on those loans are typically double digits. 2. The monthly payment now goes against your debt-to-income ratio. A payment of $100 a month can cost you thousands of dollars in loan amount availability. While I'm on that kick, we do not endorse credit bureaus that offer to boost your credit either. We have been in touch with those credit bureaus offering this boost program, and we cannot get a direct answer on whether or not the reporting of utilities or cell phone payments have any effect on your FICO score. There are some accounts that report to the credit bureaus that will only help improve your Vantage scores. This is part of the reason why FICO and Vantage scores differ. Another big reason we do not endorse this program is that now your utilities reported can be held against you when determining your debt to income ratios. When you are applying for a loan, credit furnishers will take into account your credit history, your credit score, and your ability to pay. Ability to pay is how much money do you make and how many reporting monthly payments are you responsible for. How much money is left over is the risk in whether you are high or low, and can you make your payments on time every month. So if you have a $100 electric bill and a $100 cell phone bill reporting to your credit, banks can and now will use that information and take into consideration when calculating how much you can afford. This also brings me to rent reporting companies. Many companies will report your rent to the credit bureau. Some of these companies only report to one, two, or maybe all three bureaus. Many of these accounts reporting will have a greater impact on your Vantage score, but not necessarily your FICO scores. There are still many benefits to having your rent reported, and you can find who we suggest in the links section. Okay, now back to the banks and their credit builder loans. So number 3, those credit builder loans are generally short-term loans, most common being 12-month. So that means you open an account. And remember, you're going to initially take a credit hit for the new credit and the credit inquiry. But that will rebound after a short amount of time. You start getting your positive payment history, which is the 35%. But then a short time later, you're paying that loan off and closing that account, which just negatively affected your credit score. Number 4, now by taking out this credit builder loan, you just created debt. And you are paying the bank a high interest rate to do so. You will pay the bank several $100s in interest. The one good thing about these types of loans is that you do get majority of your money back at the end of a loan term. It's not like a typical loan that you get your money up front. Credit builders loans will give you your money after all your payments have been made. We have what we think is a better option, and especially when you're wanting to build positive installment credit. We have affiliations with 2 credit building institutions, Self-Lender and Credit Strong. You can find the links in the document section. Self and Credit Strong offer credit building programs that will report to all 3 credit bureaus as an installment account. You can open an account for as little as $9. There is no credit check. And you can deposit as little as $25 a month for 24 to 60 months. At the end of the agreement, you will get all of your money that you deposited back, minus their small fee. We like to look at it as like a savings account that builds your credit. Look, some people reading this may not dedicate much toward their savings account each month. But if you asked every one of those people, would you like to be putting money in savings? They would say yes. So with Self and Credit Strong, you dedicate yourself and you take action to invest the $25 monthly. There are many benefits to it. You can open an account with both programs. The other cool thing with these great finance companies is that after you're enrolled in their program for so long, and your positive payment history, they will offer you other lines of credit that do not require deposits to continue building. So when you're trying to reach that 700, 800 credit score, you need to have at least 2 to 4 open installment accounts and 2 to 4 or more revolving accounts. They want to see how responsible you are and how you manage your accounts. Isn't that pretty much everything we just talked about? Make your payments on time. Don't overextend yourself on credit cards. Don't run your credit a lot. Don't close accounts, and have a good mix of credit. And that, folks, is credit.